the video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Well, guys, stocks and crypto are dipping again. And I'm starting to think, are we going to get that Christmas rally that I've grown accustomed to over the last couple of years? I don't know, man. Things are looking a little dicey right now. You got these institutional investors, these hedge funds, these billionaire investors starting to, I don't know, are they betting against the market right now? I'm just trying to ask myself that question. Again, no expert here. I'm not a financial advisor. I'm not trying to play one on YouTube. I'm just a guy that goes out and does some research and try to figure out, where this thing is heading so that I know how to move and deploy dollars in order to multiply them while I'm sleeping. That's all I do. I'm no expert. You guys got to go out and do your own independent research before you make any investment decisions. But I'm grown accustomed to this Christmas rally thing. And right now, it ain't looking that good. Let me walk you through what I'm talking about. We're gonna get into it right now, man. Stocks fall. Dow pulls back from record high. It just had a record high yesterday. And already, it's Thursday morning, a little dipsy. I'm thinking, well, goodness gracious, when is the Christmas rally coming? Stocks pulled back on Thursday after a continued market rotation powered the Dow Jones Industrial Average to finish to a fresh high. Now, that was yesterday. The Dow lost 115 points, or 0.2%. The S&P 500 shed 0.6%, with declines in communication services and information technology sectors leading the way. Now, y'all all know, if you've been rocking with me, I love information technology. The NASDAQ composite pulled back 1.1%. So instead of this thing starting to ramp up so we can get ready for this Christmas rally, this thing's starting to ramp down. And I'm thinking, will the Grinch steal Christmas this year? I don't know. You guys got to figure that out. But as far as I'm concerned, it's not looking good. Let's keep moving. Despite the NASDAQ starting off the week strong, pressure has since resumed as investors continue to rotate out of technology stocks, especially those in the artificial intelligence trade, amid worries about their valuations. The tech-heavy index was on track to close with a third straight day of losses Thursday, weighed down by heavyweights, NVIDIA, Broadcom, and Alphabet. So there's that rotation out of artificial intelligence stocks, specifically your hyperscalers, your mega caps, and your semiconductors, really, right? And again, investors are saying they're concerned about their lofty valuations. And all that means is they believe that they could be overpriced. But 3 weeks ago, they wasn't even saying any of this, guys, when they were just ripping everything. But that's how fast this thing can change, right? Now, what we got to determine is it manipulation? I don't know. In my opinion now, this is just my personal opinion, I think it is manipulation. You got to go out and do your own homework and figure out what you think. But I've been doing this for 30 years, and of course, no expert, But when you do something for 30 years and you just dedicate yourself to being disciplined, consistent, and patient with that thing you do for 30 years, you learn a few things or two about that thing. And this thing, what I've learned about it is that as long as I dollar cost average in to my favorite ETFs, my favorite individual stocks that have proven historical track record of performance, I'm gonna be okay. Now, that's what I've learned in this thing that I've been doing for over 30 years. Now, again, no expert, but history is your friend, even when the trend is not your friend. Let me say that one more time. History is your friend, even if the current trend is not your friend. So when I'm looking at this current trend, it's not looking good. It's not friendly. It's an adversary because it's going down. If it was friendly, it'd be going up. So it's an adversary right now. But I got to also go back on history and say, Richard, what has the stock market done over the last 100 years? See, history says stocks go up. Now, that's what history says, again. That's my personal opinion. Now, you go out and do your own homework and you come up with your own opinion. But my opinion is history tells me over the last 100 years that the stock market goes up. So what do I have to do in order to weather this storm? I got to be consistent. I got to be disciplined, and I got to be patient. Let's keep moving. Disney was one of the key laggards during the session as well, with shares falling 8% on mixed results for the company's fiscal fourth quarter. So Disney came out with its Q4 numbers, or its fiscal Q4 numbers. So Disney doesn't operate on a regular 12-month calendar year. They have a fiscal year, which I don't know when that is, but clearly we just came out of their fourth quarter. So that's what they reported. And looks like investors had mixed feelings about Disney's results. So the Disney stock fell by 8%. Now, some of us who've been around for a while may look at that as an opportunity because we know Disney is one of the great companies. They're one of the great companies in America. Matter of fact, they're one of the great companies in the world. So is that an opportunity? You got to make that decision. Let's keep moving. Wednesday, again, saw a divergence between tech stocks and other pockets of the market as value-oriented sectors such as healthcare outperformed. Remember, we talked about this rotation into healthcare, right? Anytime investors see an opportunity to get in on something before it skyrockets, they do that. And right now, in my opinion, investors see the healthcare sector as a up-and-coming bump, right? Why? Because if the Affordable Care Act, these subsidies that the government has been giving to some Americans and people who are on the Affordable Care program, if those go away, and then there is deregulation in the insurance sector, guess what? Insurance companies now can charge whatever they want. They can run prices up. They can deny claims. And you got to understand, in my opinion now, I'm no expert, but I'm giving you my opinion. In my opinion, one of the biggest things that insurance companies do to be profitable is they deny claims. They're very good at that. They haven't been able to do that lately because of regulations, Affordable Care Act regulations. But if all of that is stripped away and they deregulate them and let them go back to the old days where they can just deny people's claims, oh my goodness, I've been paying my premiums for 10 years and all of a sudden I get hit with a rare illness or something, and then they deny it. They deny your treatment. If that happens, that makes them more profitable. If they can reduce their expenses through not paying claims, that makes them more profitable, guys. And investors know that. So investors are starting to rotate out of certain things like tech and rotate into the healthcare sector, trying to get ready for this, maybe this thing goes higher. I don't know. I'm just giving you what the folks are saying here in this article. Let me read it for you again. Wednesday again saw a divergence between tech stocks and other pockets of the market as value-oriented sectors such as healthcare outperform tech. When do you see that happen? Not very often. While the NASDAQ finished the day in the red, the Dow closed above 48,000 points for the first time, putting the 30 stock index on pace for its best weekly performance since late June. Why is that? Because you got to remember, guys, the S&P 500 and the NASDAQ are heavily weighted towards tech. So when you look at the S&P, the top 500 companies in America are in the S&P, but only the top 7 companies, they carry about 30% of the weight. 7 companies. That's the S&P. So they're tech companies. When you look at the NASDAQ, obviously that's all tech. But when you look at the Dow, you got a lot of value-oriented companies, like the healthcare sector, like the retail sector, like the industrial sector, like the energy sector, right? So that's what they're saying here. Investors are starting to kind of rotate out of heavy tech and going into some of these value-oriented industries to try to do what? Capture profit. That's basically what they're doing. They're not doing it because they're doing it to make money. And that's what you see here. The rotation has been a relief for some investors looking for a broadening out of the market, but it could also signal growing caution away from risk-on assets. So what are they doing? They made a bunch of money this year, right? They've made a bunch of money in tech. A lot of these institutional investors, a lot of these hedge funds, these billionaires, they've made a ton of money in tech. Why? Because after Liberation Day, they backed up the dump truck and loaded the dump truck up with very, 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 very cheap stock prices on tech companies. That's what these big boy investors did. And then over the last 6 months, they've been riding this wave of euphoria. And a lot of them starting to say to themselves, we made a bunch of money. This thing is a little risky, little too risky. We don't want to lose all of our profits. It's a little risky. So let me do what? Reduce my risk and go to value. Let's go to proven companies with reasonable valuations, reasonable stock prices, and let's go hide out there for a while and let these riskier assets like artificial intelligence stocks, semiconductors, hyperscalers, let's pump the brakes on them for a little bit. And that's what I believe is happening right now. But here's my thing, though. That's an opportunity for a guy like me. See, I'm an opportunity guy. When opportunity knocks on the door, I open it and I ask opportunity, what do you got for me today? That's what I do. So if big boys want to rotate out into value, that leaves an opportunity for a little guy like me, a little retail investor like me, to be able to go Christmas shopping. Go get me some really nice deep discounts. Because I know one thing about these big institutional investors. They're greedy. They're greedy. They will rotate back in at some point because they're greedy. They got to. They will. I don't know if it'll be this year, guys. It might be first quarter 2026 before they rotate back in. I don't know. But one thing I do know about these greedy institutional investors and these hedge funds and these billionaires, they will rotate back in. History proves that. When they do it, I don't know. And again, guys, this is all my personal opinion. I'm not a financial advisor, and I'm not trying to give you financial advice. I'm just giving you my personal opinion about this topic. Please go out and do your own homework and figure this thing out for yourself. We have rebounded in dramatic fashion from the April lows. Didn't I just tell y'all that 5 seconds ago? This is coming from the Chief Investment Officer at Co-America Wealth Management. This is what he's saying now. We have rebounded in dramatic fashion since April lows, AKA Liberation Day. That's what this expert is saying. Most importantly, the market is broadening out beyond just growth and technology, including industrials, financials, and healthcare. That's back to what I just told y'all. He's telling you that since April. I'm gonna break it down for you. He's the expert, but I'm gonna give it to you in a non-expert's way. I'm a non-expert, but I'm gonna break this down. This expert, I'm gonna break it down in the simplest terms that I can understand it. Maybe some of you might understand it, but go do your own homework. What he's basically saying is what I just told you. He's saying big boy investors swooped in, bought the dip after Liberation Day, and I still think that was a manufactured dip. I think the 1% behind closed doors manufactured the whole thing. So that's my opinion now. That's only an opinion. I'm not an expert. That's an opinion. I think they manufactured Liberation Day. Backed up the dump truck when everything dipped to dip. They backed up the dump truck. Loaded up the dump truck with very, 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 very cheap prices. And then for the last 6 months, they've been propagandizing and running these things back up. Now, what he's saying is, now they're starting to say, you know something? Getting a little bit itchy, getting a little bit uncomfortable with all of my eggs in this artificial intelligence, growth stocks, tech stocks basket. Let me roll out of this thing and go to something else that has a little bit more safety. And what they believe, according to this expert, a little bit more safety includes industries like industrials, financials, and healthcare. Question you got to ask yourself is how long will these guys want to risk off? Can it be the rest of this year and then in 2026 they risk back on again? I don't know, guys. I just know if they rotate out, things go down, that's an opportunity for me to buy the dip. And then I just got to be disciplined, consistent, and patient. Market says history, well, not the market, but the history says of the market that at some point we come back and we come back strong. Don't know when that is. Small cap stocks are also participating in the rally as lower short-term interest rates have been a harbinger for small cap outperformance. What he's saying here, break it down to simplest terms for you, at least according to my little 2 cents. What he's saying here is when interest rates come down, who benefits the most when you're talking about companies? Normally, it's small companies benefit the most when prices come down or when interest rates come down. Why? Because now these companies, these small cap companies can go out and borrow money cheaper. And then they can take that money that they borrow cheaper and put it into their growth so they can grow. That's why small caps normally benefit when interest rates go down, more so than your big mega caps. Because your big mega caps ain't really out there trying to borrow money in most cases. They already have 20, 30, 40, 50 billion dollars in free cash flow on the balance sheet already. But really, it's these smaller companies who struggle to have cash reserves. They're able to go out and borrow money a little bit cheaper, so they benefit when interest rates go down. That's coming from the expert. Now, I broke it down in my little 2 cents to understand. For me, I wanted to give it to you. But let's keep moving. Investors were optimistic during Wednesday's session, that was yesterday, that the U.S. government shutdown, the longest in history, would end after lasting 6 weeks. That outcome came to fruition that evening when President Donald Trump signed into law a funding bill to reopen the federal government. The bill, which has been passed by the House of Representatives earlier in the night, will fund government operations through the end of January. So here's the thing. Investors are saying to themselves, okay, here they go again. They're kicking the can down the road. They're kicking the can down the road. Richard, what does that mean? That means you still don't have a long-term spending bill in place. So guess what happens? In the end of January of 2026, we could be right back in the same boat with another government shutdown. See, investors are starting to see all of that and saying to themselves, this doesn't look real good short term for us. This does not look real good over the next 3 months. We're already in November, December, and then comes January. And guess what? They don't have a long-term spending bill approved. So we go right back to another government shutdown at the end of January. So guess what investors are doing? They're saying, hey, man, that's just too much risk. Let's move out of some of this volatile growth type of stuff, overvalued stuff, and let's move into something more reasonable that has a proven historical track record. We feel comfortable with the company valuations for about 3 months until the government can figure out whatever they want to do with this spending bill, because we're going to be right back in the same boat January 30th if they don't come up with a long-term spending bill. And here's the thing, they won't. Just want to give y'all that little FYI. They will not come up with one. They won't. Y'all know these people ain't gonna come up with these government officials, the House, the Senate, the White House. They're not gonna come up with anything other than how to enrich themselves. So you better figure out a way to get yourself a financial safety net through all this turmoil, because if you don't, you're gonna be stuck like Chuck. You don't want to be stuck like Chuck, man. The extended stoppage caused investors to fly blind without key economic reports, such as the October jobs report and inflation data, and contributed to the market's recent choppiness. See, investors don't like uncertainty, guys. When I say investors, I'm talking about hedge funds, institutional investors, billionaire investors. They do not like uncertainty. Now, right now, when you got this, hit or miss economic data, you're not getting an accurate jobs report. You're not getting the CPI inflation reports on time. You're not getting other critical data that investors use to make investments. You don't get that stuff on time anymore. So you're basically flying blind. Investors don't like that, man. But again, long term, for a guy like me, that's an opportunity. Short term, it's going to hurt. There's going to be some pain. I'm feeling some pain right now. Short term, in the portfolio, I'm feeling some pain right now. But see, I got history to lean on. I know this will end. We will get back to a level of prosperity. That's my opinion. Now, you go out and do your own homework, but that's my opinion. Investors are sick and tired of this. Oh, I might get a report. Oh, I'm not going to get a report. Oh, you got, the White House press secretary coming out saying they may never produce data again. Like, what in the world did this lady just say? This lady came out and said, it's all the Democrats' fault. You may never get data again. I'm like, what in the world did this lady just say? She said, we may never get economic data again. I'm like, boy, these people have lost their mind. But this is what I'm talking about. So when you hear the press secretary say something like that, you know it's coming from the top. She don't just come out there and say any stupid thing now. Whatever that lady say in that press conference every day, I don't know, can't remember her name, but y'all know who she is, the blonde-haired lady. She press secretary for President Trump. Anytime she come out and say something, y'all already know that thing coming from the tippity top of the food chain. She don't just get out there and just free willy and do her own thing. That's coming from the food chain. And here's the thing. If these people, they may not give you any more data. You may not get a jobs report again. You may not get a CPI inflation report again. You may not. Who knows? So that's what investors are thinking right now. They're like, man, listen, I like Meta. I like NVIDIA. I like them, but goodness gracious, I don't like them that much. I might want to go back to some of these little proven industries like industrials and healthcare and retail. You know what I'm saying? That's what they're starting to say. Let's get out of this thing while we still got the clothes on our back, the shirt on our back. So let's keep moving here. White House press, see what I'm trying to tell you? Y'all think I'm reading ahead. I'm not reading ahead, guys. I just be listening to this lady and listening, and then it just falls right into place. So this is what the article says now. Y'all think I just said something about Caroline, whatever her name is. Caroline, what's her name? Caroline Levitt. I ain't got no problem with Caroline Levitt. I don't want to pick fights with nobody, so don't come emailing me or sending me no DMs. I'm not trying to pick on this lady. This lady's just doing her job, okay? So let's get that straight. I don't need need y'all coming after me. Oh my God, you're attacking her. No, I'm not. I'm not attacking anybody. I'm just reading an article here. White House press secretary Caroline Levitt told reporters on Wednesday that these reports may ultimately never be released. Come on, man. Listen, man. You can't make this stuff up. You cannot make this stuff up, guys. I mean, are you kidding me? Let me read this for y'all again. Y'all thought I was just throwing something. This is what she said. Check it out. Caroline Simonetti, press secretary, told reporters on Wednesday that these reports may ultimately never be released and that the shutdown could lower fourth quarter economic growth by up to 2 percentage points. Most economists expect minimal impact to U.S. GDP, however. You see what they're trying to set up, right? And again, guys, I don't have a dog in the fight. Hey, listen, whatever. I'm just telling you my opinion. This is what they're trying to set up. This is what Trump organization, government, administration, whatever you want to call it. This is what they're trying to set up. Now they're trying to say, because of the government shutdown, all hell done broke loose. Everything is terrible right now because of the Democrats. It's all the Democrats' fault. This is what they're setting up. That's why this Caroline Levitt lady is coming out saying, oh, since they shut the government down for 40 days, we may never be able to give y'all these economic reports again. Also, not just that, the GDP for 2025 will probably be worse than if we not had the shutdown. See what they're trying to do now? And of course, they're blaming the whole shutdown on the Democrats. So guess what the messaging is? The messaging is, if the economy goes in the crapper, it's not our fault. If the economy skyrockets, then we'll take credit for it. That's just my opinion now. Again, I ain't got a dog in the fight. I'm just telling y'all what the article is telling you. This is what she said. We may never get economic data again. And who do you think perked up when they heard that? Big time investors. Big time investors perked up. The gears of the government should be working again soon. And while that is a relief for markets and the economy, there's still plenty of uncertainty, particularly around missed inflation and jobs data and how these fronts have been faring. This is coming from Chief Market Strategist at BMO Private Wealth. While we have always expected that many of the data points missed during the shutdown will remain dark, there are questions about the inflation and jobs data will look like once these reports come back online. We would not be surprised to see some market chop over the coming weeks as the government gears and economic data presses getting turned on again, she added. The blackout posed a challenge for the data-dependent Federal Reserve, increasing investor pessimism, not optimism, but pessimism about the prospect of lower interest rates. Still, she said, she expects the central bank to cut its benchmark overnight borrowing rate at its upcoming meeting in December. Markets are rather split on the likelihood of that happening. Here's the likelihood that I think it'll happen. I think it's a good likelihood of it'll happen because you ain't getting no data. See, when the Fed don't get no data, they have to go into worst case scenario, guys. And you think the Trump administration don't know that? They know that. They know, don't give no data out. It has to be doomsday, because that's what the Federal Reserve has to go with. You got to err on the side of the worst case scenario if you're the Federal Reserve. You already know the labor market has been weakening over the last 3 or 4 months. You already know that. You also know inflation, although up year over year, about 3%, at least according to the September CPI inflation report. But that's still within, it's not within guideline, but it's within reason. The mandate is 2%. I'm at 3% right now, but the mandate 2%. But you got a labor market that's really weakening. You got no labor statistics data coming out from the federal government. None. You got ADP report. That's it. That's all you got. You got nothing coming out from the government saying, hey, here's where we're at with jobs. Now you got Caroline Leavitt, press secretary, saying, look, if the economy goes into the crapper, it ain't our fault. It's all the fault of the Democrats. That's what she's saying. She also saying, we may not give out any reports. I don't know, man. For me, though, the more chaos, guys, for me, because I'm a long-term guy, the more chaos short-term is a benefit for me. Because all I'm going to do is continue dollar cost averaging in every 15th of every month like clockwork. So the more chaos in the short term, even though it pains, it's a little painful to see the portfolio down. It's painful. But I know it's short-term pain so that I can get a lot of long-term gain. That's how I look at it, baby. A lot of short-term pain. But I know history tells me if I'm just patient, if I'm just disciplined, if I'm just consistent, it's going to be a lot of long-term gain. Y'all drop me some comments and let me know what you think. I'm just telling you, crypto ain't doing no better. Let me give you a little tidbit on crypto, and then we're going to get out of here. Y'all know I don't get into crypto that much, but let me give you a little crypto. Just a little something, something. Here's a little something, something on crypto. Little something, something. From November 1 to November 13, 2025. Now, when I say crypto, guys, I'm talking about Bitcoin. The rest of that stuff, I don't know anything about. I don't know anything about Bitcoin either. But Bitcoin is the 900-pound silverback gorilla when it comes to crypto. So that's all I'm talking about. When I say crypto, I'm talking about Bitcoin. Not all that other stuff y'all be buying. I ain't talking about that. So Bitcoin dropped from a price of approximately 109,559 to around 102,607, representing a decrease of about 6.3%, guys. This is from November 1 to November 13. The currency experienced significant volatility during this period, including a dip below $100,000 on November 4th before recovering. So even the beloved crypto / Bitcoin is very volatile and choppy. But again, the spoils go to the brave. Let me say that one more time, and I'm going to get on out of here. The spoils go to the brave. Now, some of y'all know what that means. Some of y'all don't. Go to ChatGPT, go to Google, and type that in, and they'll tell you what that means. I ain't got enough time to go through all that today. But for those of y'all that know what that means, the spoils go to the brave. So my job right now, guys, is not to be a panicking. It's not to be a panicking. My job right now is to be brave and to lean on what old Buffett said. Buffett said, be greedy when others are fearful and be fearful when others are greedy. Y'all already know that's a billionaire. That's a billionaire. He's a billionaire. All right, man, I appreciate y'all rocking with me. I'm gonna get on out of here, man. Y'all have a good rest of your Thursday. And again, you have a choice. You can be a panicking or you can be brave. You can be a panicking or you can be brave. You can be a panicking or you can be brave. Drop it down in the comment box if you're going to be a panicking, and be honest. If you're going to be a panicking, ain't nothing wrong with that. If you're going to be a panicking, put it in the comment section. If you're going to be brave, just put brave in the comment section. Either panicking or brave. I don't need a bunch of the rest of that stuff y'all be putting in the comments. But put brave or panicking. Let your boy know which one you're going to be. I appreciate y'all for rocking with me. And also, don't forget, down in that description box, you got that Moo link. Up to $1,000 in NVIDIA stock when you open up a new Moo brokerage account, guys. Brave or panicking, you got to decide. But the link is down there. Go check it out. First link. Also, second link, Wealth Builders Financial Community on Patreon, man. Go check us out. That's where I'm giving out the real game. That's where we talk about this kind of stuff. No experts, just regular people trying to figure out a way to get to financial freedom, ultimately passive income. You want to be a part of that team? Click on that Wealth Builders Financial Community link, second link, Patreon link. Come join us, man. Come check us out. And then send me a DM to let me know you're rocking with me. Appreciate y'all, man. Stopping by the channel for the first time, please consider subscribing, share the video, smash the like button. Thoughts become things. If you can see it in your mind, hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. Stay healthy, get wealthy. And I'll catch you on the next video. Peace.